Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by James Wallace, Dan Innes and Nicol Dynes. And we'll also have a special focus on digitisation of real estate. But let's start with the roundup of the week. Dan, what have you been following?
The developing news for me this week comes firstly out of EPRA and their views on the residential REIT market. There was an article published on Friday in Property Week from Sally Hickey showing that investors have got a bit of a renewed appetite for residential REITs, principally based on shares in those REITs trading at a premium or a discount. And the EPRA research data reveals that although trading did drop to a discount of about 16% during lockdown, and that's bearing in mind that, remember, that pre-lockdown, they were trading at a premium position of about 13-14% pre-COVID, but that position is actually recovering strongly. And so there are many operators, people like Granger, who are already showing that they're trading nearly back towards parity and really good confidence in the residential sector as a whole. The big listed story of the week, of course, has been Hammerson, and the UK and French REITs been looking to raise around 800 million in a bid to offset the negative impact of COVID, especially in the UK retail industry. I've just been following the sale of its 50% stake in Via Outlets, which is now just subject to board approvals. The Via stake is one of their crown jewels in its portfolio, really, and it's a particularly resilient quarter of the retail sector. And they're, of course, selling it to the owner of the other 50%, APG, the Dutch pension fund, for around 300 million euros. And that's going to give APG 100% control. Via's strategy to position its centres as premium fashion outlets has pretty much followed this re-merchandising, remodelling and remarketing model. And there's no reason to suggest that that's going to change. And they've now got 11 centres in 9 different countries on the continent. So, I mean, that Hammerson story really is probably the standout of the week, Richard.
It's interesting. We've done quite a lot in terms of following Via Outlets, particularly in living retail as well. And that part of the sector seems to be less affected by the general issues with retail. James, what have you been picking up on?
Well, actually, just following the thread from Dan there, I mean, the broader context of at the corporate level of the Hammerson story is that the sale of its European shopping outlet business Via Outlets, it's actually in sterling, it's 274 million, and that's part of 825 million pounds they're trying to raise. The bulk of it, just over 550 million pounds, is through a rights issue. Obviously, they're trying to stave off a fate for similar to their nearest rival, Into, which collapsed into administration. It's the second large-scale example of how quickly a REIT's liquidity problems can descend into a fairly existential solvency crisis. And so Hammerson's trying to shore up its balance sheet, and it's made many other steps in its half-year results. So that it's announced this kind of pivot towards continental sort of leasing model for its tenants, which they've said is going to sort of rebase rent at a lower level. It's going to provide indexation, replacing the existing rent review system. And this will have an impact on valuations. And I'm sure the analysts will say in the coming weeks, when they've had a look closely at this, that it may well rebase these valuations at a more stable but lower level. I mean, Hammerson has argued that, like, COVID has exposed the weakness of the UK leasing model, which is no longer fit for purpose. I mean, critics would kind of say that these weaknesses in the retail sector sort of predate the pandemic. So have they acted a bit too late, or were they not focused closely enough on the issue of leasing, and where they're too broad in their strategic review of kind of, trying to get to grips with the Amazon effect and the sort of, the move to e-commerce more broadly, that they turned their eye off the ball and looking at the specific problem of leasing until it became a critical problem. Overall, Hammerson posted it's like a 1.1 billion loss in the first half of the year. They collected about 70% of rent due in H1, and so far today they've confirmed only 25% of Q3 rents have been received, and so these troubles continue. We probably expect more of these problems at smaller scale retail investment companies that don't need to provide such regular, transparent information. It's just we just see it so transparently because they're listed in their REITs. If you remember, just to sort of put this into context, a little bit over 2 years ago, the French shopping centre Klépierre offered Hammerson a kind of 50-50 cash and stock offer to buy Hammerson at 635 pence a share. So that valued Hammerson then, 2 years and 3 months ago, at about £5 billion. Today, as we record this, share price is around 47p, which gives a market cap of 362 million. So it just shows how enormously rapid things can change in a short period of years.
Yeah, no, very interesting. Nicole, what have you been seeing?
Well, there's a lot of controversy in the UK over the government has published a white paper. It's called The Planning for the Future, and it's been dubbed as the most radical overhaul of the planning system since the Second World War. And on the positive side, it is meant to have at least 300,000 homes built a year to speed up the planning process. At the moment, it takes 5 to 7 years for a planning application to go through. The government wants to speed that up. And because of this sort of speed, on the positive side, the shares of the house builders have gone up on the LSE, because obviously the idea is for the sector to get more work. On the negative side, which is considerable though, is the government taking very much control. This new planning regime would take away the right of local councils to veto developments. And there are basically three categories: areas for growth, areas for renewal, and areas for protection. And all the areas for growth, basically, they almost automatically get planning permission to build homes. So Labour called it a developer's charter, and REBA, the British architects, called it the shameful proposal. So there's a lot of controversy and a lot of details that will be filled in. But what is interesting also is the fact that it's very much also digitisation of the planning process, because in the growth areas where planning applications should be automatically granted by computers. So that should obviously also help to speed up the process.
As part of that, the government's going to contribute to fund Manchester's first city centre park in 100 years. And that's part of a whole raft of different outdoor spaces. This park is going to be 6.5 acres. It's described as a once-in-a-generation opportunity, part of £1.4 billion of development. It was reported in The Guardian that this £23 million pledge by the government is to come from that Getting Build and Fund. And actually all of their investments are all listed on the government website, actually. There's quite a few park developments around the UK, including Leeds and Sheffield as well. So I think there are some good things to come from it, but as Nicole says, it has been quite controversial.
Yeah, it's interesting also that digitisation of real estate, and especially that coming through the planning, there's also been a lot of discussions around that in terms of digitisation being part of the solution to valuations, particularly at this time. I noticed Prologis posting on LinkedIn just about their digitisation project in general. That's one of the things that we're working on RealX.global, just giving the opportunity really to be able to use in a digital space what you can't do at the moment in a physical space, because it still looks as though, you know, many of the physical events, but also the ability to be able to travel is likely to be restricted probably until the end of the year. And James, you've been following a lot of this digitisation strategy.
I've been following it and been closely involved in the market for over 5 years. And there's always been a compelling case that we digitalise the workflows that relate to the life cycle of real estate. And that goes from, as Nicole says, planning and development all the way through to kind of like the transactional activities, due diligence on assets, the monitoring of assets, property management, leasing, financing, capital raising, client reporting. I mean, it really is across the entire cradle to grave of real estate assets. And then sort of underpinning these kind of digital ecosystems is kind of proprietary data mixed with kind of third-party data that you take subscription services to. And the integration of this data in these kind of ecosystems that connect to your peers that you're doing deals with, as well as your service providers that are related to those deals, creates a kind of an incredible efficiency in getting transactions done. And of course, things like the pandemic just show you that the utility of having ecosystems that are digitized. And so I've seen a lot of talk in a lot of the results of a lot of various property companies, both in the UK and on the continent, where they're talking about making further investments into their technology solutions because it makes sense. It was something they were going to do at some point, and I feel that there's just more evidence now that they're putting their money into this investment. And so we expect to hear more from that over the second half of this year, for sure.
Thanks very much, James. Thank you, Dan. Thanks, Nicole. Thank you for joining us, and look forward to seeing you next week.